Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. And every month, we keep tabs on the 2025 earnings and year-end S&P 500 estimates from 22 street strategists tracked by Bloomberg. This month is the first time where not a single change was made to either data point by any of the group of 22. What does that say about the current environment? Either we're too exhausted to keep up, or it's all bluster. Maybe a bit of both. For what it's worth, the median estimate for the S&P at year-end is 6,600, which would be a nice 12% bump for the year. The median EPS estimate is $271 a share, 10% above the 2024 estimate. It's all good, right? All right, this week our three things are: 1. Homebuilder blues. This engine of growth is slowing. 2. Walmart guidance. What it says about the consumer. And 3. Tight spreads. They should be wider, right? Well, all right, let's dig a bit deeper. Homebuilder blues. Now, admittedly, part of the housing story, the we're chronically short 3 to 5 million units part, we struggle to understand. Yes, I know builders are scarred from the GFC, and costs are always rising for materials and labor. If home prices were stuck in the doldrums, I'd understand. But home price appreciation marches on. Theoretically, there's an economic incentive to build, yet we just can't seem to close the gap. Now, leaving all that aside, housing matters economically. Residential development accounts for around 4% of GDP, and housing services, which includes rents, including owners' imputed rents, make up another 12% or so. And there is all of the indirect activity that housing creates in its wake. Buy a house and fill it with stuff. Housing sensitivity to rates has always made it Exhibit A when observers question the impact of monetary tightening. Now, flash forward to today, and home builders are facing even greater uncertainty. Buyers are still coming to grips with higher mortgage rates. Tariffs could impact future materials and costs. Immigration initiatives will likely affect supply and cost of labor. So it's no surprise that all of that is weighing on homebuilder and homebuilder investor sentiment. The S&P Homebuilders Total Return Index has lost nearly 15 points since October, underperforming the S&P Equal Weighted Index by some 18 points. The latest iteration of the National Association of Homebuilders Market Index out this week fell to 42. 50, by the way, is the dividing line between good and poor. That's down from 47 in the prior month, and it's now at its lowest level in 5 months. The subcomponent, expected sales over the next 6 months, fell off a cliff from 59 to 46. In the index's English, from good to poor. Now, topping off this not-so-good week was a sales and earnings miss out of Toll Brothers, driven by what management said was mixed results across its businesses. Its stock was off 6% on the news. Now, much of this spate of bad news reflects the uncertainty hanging over near-term earnings growth in the sector. And yet, the equity market's reaction feels like a correction rather than a repudiation, as home builders have had a very good run over the past 2 years on the back of an economy that was holding up far better than expected and where restrictive rates were coming down. Still, much of the survey's reaction is tapping into something we see cropping up in lots of places: uncertainty. An overhang for sure, but not enough to materially undo underlying strength in the economy. And we still need to build more homes. All of that makes home builder performance still good enough for credit. All right, on to our second thing, consumer inflection point. So we've learned over long careers that you question the spending persistence of the indomitable U.S. consumer at your own risk. Underpinning the phenomena is a robust economy that continually innovates and evolves, and a financial system that knows how to fuel growth and lend to all strata of the consumer wealth spectrum. The Q4 GDP report showed the strength of the consumer in clear terms. Consumer spending up 4.2% sequentially, accounting for all of the period's growth and then some. So why are we talking about an inflection point? Well, because growth is normalizing. Excess stimulus wealth is greatly diminished. That's not news. What is growth in real wages. It's flattening out. And slower growth figures to do the same to the wealth effects from home and investment portfolio gains. And that, of course, would pose a risk to the top 40% of income earners that drive some 60% of total spend. Among less wealthy households, the struggling part of our two economies theme, the cumulative effects of above target inflation and reduced borrowing capacity are very headwinds to spending from that sector. And spanning the full range of consumers is, you guessed it, uncertainty. Is my job secure? Will wage gains offset inflation? Will I be able to borrow when I need to at rates that are what I'm used to? Consumer confidence has rolled over in both the Michigan and Conference Board surveys. The latest Reuters Ipsos poll show that 53% of Americans today believe the economy is on the wrong track. And by the way, that's up 10 points from January. We saw a lot of this show up in January retail sales, where the control group that feeds directly into GDP consumption tanked, down 0.8%, the worst level since February of 2022, and a sharp drop from December's 0.8% rise. Now, cold weather and California's wildfires probably depressed the latest figures somewhat, but the declines were, for the most part, broadly based. The trend is not likely our friend here. Walmart's fourth quarter earnings fit into this slightly more cautionary theme. The news was less about the 3-month look back, which was solid. It was all about management's less than ebullient guidance. For the upcoming year, earnings are expected to come in between $2.50 a share and $2.60 a share. That's 6 to 10% below the consensus estimate of $2.76. Sales growth is targeted to come in between 3 and 4% versus the street's view of 5%. What's more, tariffs are not explicitly factored into this guidance. Management said they continue to face a, quote, consistent, resilient consumer, unquote, but acknowledged that while its outlook assumes a relatively stable macroeconomic environment, there are still uncertainties, there's that word, related to consumer behavior and global economic and geopolitical conditions. To us, all of this is consistent with normalization, bringing the overall economy's growth back toward potential, call it 2%. And that's a far cry from where we've been over the past 3 years, where growth has averaged 2.7%. All right, on to our third thing, tight spreads. Not a day goes by where we don't get asked when spreads will widen. Markets are priced for perfection, the thinking goes, in an increasingly imperfect world. Well, tough to argue with that. So what gives? Well, here are some thoughts. 1, total returns matter. That's price appreciation plus risk premium. Credit yields 5.3% for public investment grade, 7+% for private investment grade, assuming liquidity premiums expressed by alternative asset managers. 7.2% for public high yield. Now, the credit quality in that sector, of course, has improved significantly from the past, given a higher percentage of double Bs, and upwards of 10+% for private high yield. The point is, relative to stocks priced in the top decile of multiples, credit looks appealing. That should keep flows coming into the asset class, which will keep spreads tight. Second, a strong economy provides a buffer against shock. Yes, we are normalizing, with consensus calling for 2.2% growth in 2025, but that's still above potential and enough to keep the labor market healthy. Are there a range of outcomes related to Trump policy leanings? Of course, but investors are convinced, at least so far, that what is coming out of Washington is far more bluster and negotiating tactic than reality. It also shows that investors take comfort in the Fed put, something we saw play out the last time, 2018 and 2019, when a tariff overhang dented investor sentiment. And 3, there are guardrails against the worst policy instincts that have the potential to wreck returns. Scott Bessent, markets, and bond vigilantes all figured a way in real time to curb potentially destructive missives from the administration. Bessent and his obsession with the 10-year should keep the messaging sure-footed and constructive from Treasury, and that should keep the bond vigilantes at bay. And no president likes a falling stock market. Look for this president to take his cues from that daily scorecard. Now, investors might seem to be complacent at this point, but it might be for good reason. It takes a while for the impact of the known unknowns related to tariffs, immigration limitations, and tax cuts to crystallize. That argues for spreads holding in, at least for now. So there you have it. 3 things in credit. 1, Homebuilder blues. reality has set in. 2. Walmart guidance. This fits into the normalization theme. And 3. Tight spreads. Attractive relative value and solid fundamentals keep the bid strong. As always, thanks for joining. Don't forget to check in on kbra.com for our ratings reports and our latest research. We'll see you next week.